Welcome to the Fear and Greed Business Interview. I'm Jennifer Duke. Australians are investing less, and when they do, they're investing more conservatively. But it's not just market volatility and economic uncertainty that's driving the change, it's also a shift in personal circumstances. These are some of the findings from HSBC's Investor Insights Survey, which is in its second year. Now, Sean Elmer spoke last year to Donahue D'Souza, head of investments at HSBC, when the survey was first conducted. So it'll be interesting to see just how much things have changed. Now, firstly, please remember this is general information only. You should definitely seek professional advice before making any investment decisions. Don, welcome back to Fear and Greed.
Hi, Jen. Good morning. Thanks for having me.
Good morning. So let's go through some of these findings because they're quite interesting. Just how many people have changed their investment strategy in the last 6 months?
Well, Jen, this statistic is quite pleasing, actually, given all of the uncertainty and obviously the higher interest rates. That's obviously there's concerns of an economic downturn. There's been increases in energy prices, food prices, a big impact to household budgets. But it looks like investors have proved quite resilient. They've anticipated these changes, and 76% of the respondents polled that they had adjusted their investment strategy over the last 6 months. 29% had adopted a more conservative approach. 40% had gone a little bit less risky to a more balanced approach. And clearly there was possibly a younger segment that saw an opportunity, and about 10% of the respondents there moved to a little bit more of an aggressive stance.
That actually really surprises me because we are hearing, obviously, in the cost of living crisis that younger people are being hit more. Were you surprised by that stat as well?
They do tend to contradict each other. I expect that whilst the cost of living has gone up, Gen Y and Gen Z have a much longer time frame to achieve their financial goals and investments, and therefore they're able to ride out a little bit more volatility and uncertainty and take on that additional risk in order to get that return. So it's not surprising that they've gone a little bit more aggressive. As far as impacts to their household budget, it's potential they may have adjusted other parts of their expenditure to accommodate their investments or their regular investments. They may have even moved back home to save rent.
I'm curious about these people who are shifting towards the conservative strategy. So that's sort of slightly the older demographics in your survey. What does that conservative strategy maybe look like? What are some of those assets that they're pivoting towards?
Yeah, great question, Jen. I think with the uncertainty, it's getting harder and harder to pick a individual security and try to get that performance. And then there's the maintenance of individual stock holdings as well, the fact that you need to review them regularly, particularly amid heightened volatility. So particularly amongst the older investors, we're seeing a pivot towards fixed interest investments. And if they're not prepared to pick individual fixed interest investments and bonds, then we're seeing a pivot towards exchange traded funds, which effectively can give you access to a broad range of asset classes, geographies, industries. So the key benefit there is diversification. And we're also seeing a pivot towards managed funds where, like an exchange traded fund, but it does have the benefit of an expertise of a professional fund manager that's actively managing that portfolio. So there, if things turn a little bit sour, then the fund manager will actively manage that portfolio, de-risk that portfolio, maybe deploy some hedging strategies. And where there's an opportunity, they can actually dial up exposure and give you that return.
Definitely makes sense as to why people are heading towards those sorts of assets and strategies and I suppose, assistance. I'm curious about how you see this playing out for the rest of the year, particularly as there's now forecasts that we might have reached that interest rate peak.
Yeah, another great question, Jen. Yes, we have. In Australia, there's a lot of eyes overseas as well, in the US and obviously broader Europe. And whilst seemingly it seems that we might have reached the peak in the interest rate cycle, I think the concern now is shifting towards what the impact of those aggressive rate hikes is going to have on the economy overall, and obviously corporate profitability and corporate earnings. And that's effectively going to impact the share market and share market performance. So I don't think investor sentiment and confidence is going to improve anytime soon. And I dare say that they will probably stay in a balanced, more conservative stance until the dial changes and we start to see an improvement and more positive signs in forward-looking economic data rather than backward-looking economic data.
Stay with me, Don. We'll be back in a minute. I'm speaking to Donahue D'Souza, Head of Investments at HSBC. I'm particularly curious about one statistic that was in the survey, and it found that there was a 7% decline in female investors since 2022, and that was comparing to a 4% decline among male investors. Do you have any thoughts on why we're seeing that split between the genders?
Yeah, Jen, that was a little bit disappointing. I know the industry as a whole has been working really hard to, one, address the pay gap situation, but also to empower our female investors to make more proactive financial decisions and eventually achieve financial independence. So that was a little disappointing, but not altogether unexpected, given that there was an overall decline because of the circumstances in the periphery. However, you would anticipate that coming off a lower base, you would expect the female investor base to be a little bit more impacted than the male investors. But one thing that I do take heart from is the fact that there is still an ongoing contribution, and it may well be that female investors have cut back on discretionary investments. As long as they continue to work and they're making indirect investments via super, I think that's still a good thing. But obviously, women are more likely, as proven by the stats, that they're more likely to take career breaks or reduce their working hours, whether it is carers leave to look after elderly parents or parental leave to look after children. All of these things are going to impact their superannuation contributions and the way in which they can retire in the end. So it's good that the survey's polling this out, but there are a lot of distractions right now. So we're living in a post-COVID environment. Savings during that COVID environment is funding quite a few things, and in particular have gone towards rebalancing that household budget amid the higher mortgage, higher rents, higher food prices, higher energy prices. But we're also seeing the travel bug back there. So that might be polluting the statistics a little bit.
It's fair enough, the holiday habits that we have. There was also this big divide in the survey between men and women in their knowledge on how to invest outside of Australia. So I think it was 53% of men compared to 35% of women are aware of how to do that. Does that add further weight to this argument for a greater focus needed on sort of financial investment literacy education?
Oh, definitely, and that's why we run the poll is one to help the industry and help each other to identify what are the areas that we need to focus on, and where this education is needed. I know that many of the issuers and the exchanges as a whole have spent a lot of time focusing, particularly on ETFs and managed funds, because you are able to get that broad, diversified exposure, and it's quite easy to get overseas exposure. It may come down to an aversion to risk. And naturally, when you're looking at investing overseas, you are taking on additional risks. So potentially there might be something there where if you are risk averse, then you're much more comfortable staying within Australia.
And of course, we don't want to make sort of widespread assumptions, but is this suggesting that female investors tend to be more risk averse?
I think if you read through some of the ABS statistics, the fact that women are more likely to take breaks, they're effectively got less contributions, they're effectively working less. And therefore, if they've got a smaller amount of capital that they need to manage and obviously achieve some sort of comfort in retirement, then you could anticipate that, okay, I might be a little bit less aggressive in my investment approach because I've got more to lose.
I think that's a very fair comment. And I also thought it was really interesting in the survey that Australians think that they need, it's about $15,200, if I'm getting that right, as the minimum amount to get started investing. Now, we're not an investment podcast, and we always encourage people to get professional advice, as you've heard. But surely a figure like that is a bit of a barrier to someone's mindset, particularly for those younger generations, and thinking, yes, I have enough, I can get out there, I can do some investments. What are your thoughts on it?
Yeah, the poll revealed, I mean, it was an average, and it was the perceived in minimum investment amount was higher than last year. I think 14,800 last year, 15,200 this year. It hasn't moved substantially, but you're right. there have been multiple apps and providers that have come out that are effectively appealing to the millennials and Gen Z to invest steadily and regularly over time. And obviously the costs are quite slow. Speaking of costs, though, I think there's been plenty of media focus on it. So whilst you can invest a small amount, you still have to pay brokerage of some description. And when you're investing a small amount, in percentage terms, it can add up. And therefore, the return you need to achieve on that minimum investment just to cover your brokerage or your initial investment cost can be substantial. So what we're also seeing is because there's been a pivot towards the more diversified exposures through ETFs and managed funds, possibly through managed funds, because some of the managed funds may have a minimum that may be reflected and captured in this survey. And that's why I think when you're pivoting towards an actively managed investment because you prefer to have a professional supervise and have oversight over that investment, some of those managed funds have a $5,000 or a $10,000 minimum. So that, I suspect, is what's been captured in this survey.
That makes sense. And one more question, just because I'm curious. If we were to do this interview again in 6 months' time with another survey result, what figure would you like to see improvement on most?
I think I'd definitely like to see improvement in the female participation. I'd like to see that segment a lot more involved. And there's plenty of female financial advisors, female financial commentators. So some really good role models out there as well. And the industry as a whole is working really hard. One thing I would like to call out, though, is that in this survey, which we haven't talked about yet, but I'm going to drop it in now, is that the survey, the respondents show that in the last year, there must have been a surge in the number of social media platforms and social media commentators in the finance world. And I think it got a little bit crowded and a little bit too noisy because the survey showed that they're pulling away from social media and they're going to the usual reliable podcasts, financial websites, issuers and fund managers and the traditional sources of information where they would get their economic or financial updates.
That's fascinating. That's truly some food for thought, I think. Don, thank you so much for talking to Fear and Greed.
Thank you so much, Jen. Thank you for having me.
And that was Donahue D'Souza, Head of Investments at HSBC Australia. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Jennifer Duke, economics correspondent at Capital Brief. Have a great day.